William, because so much has happened in the last 3 months. We were just discussing earlier today that it's been 5 years since we started doing regular quarterly coverage of CBDCs and cryptos and the entire digital payment ecosystem. But since the Genius Act got passed in the US, it clearly is evident that we have taken a leg up. We knew that this administration in the US was going to be very crypto friendly. If you look at the kinds of people who supported Trump during his election campaign, from Musk to Thiel to the Winklevoss brothers to Mark Anderson, these are all the tech bros of the West Coast. And they have traditionally not really supported a Republican, but this time they're all behind him. And he is rewarding their loyalty, whether it is the strategic Bitcoin reserve that got set up soon after Trump became president, to the Genius Act, to even recently this working group from the White House that issued over 100 regulations or rulings, suggestions about how to regulate and conduct the crypto and digital asset ecosystem. So lots going on, and it's not just in the US. As you will hear during the course of this webinar, as my colleagues Chang-Will Young, Nathan Chow, and Samuel Say will present, that the ripples from the US are hitting particularly the shores of Asia in a very profound manner, and lots of things are happening in China and in Hong Kong. So it's an exciting time, and doesn't mean that it's only an unambiguously positive story. We might be moving too fast in certain areas. There are some questions on regulation, but there are even more profound questions of the nature of money and monetary policy transmission and the ubiquity of these assets in a fiat-based system. Something might have to give. We'll see whether this cheerleading by the US lead to fundamental structural improvements in the safety, security, and governance of the crypto ecosystem, or it actually leads to a worsening. Time will tell, but let's just get the ball rolling here. I believe, William, you will go first.
I'll go first.
And we have our colleagues Nathan and Samuel connecting from Hong Kong. Hello, guys. And they will take their turns in going over the material as well, and hopefully we'll have some time for question and answer. William, all yours.
Right. So it has been 5 years since we started covering digital assets, and so much has changed. Next slide. So I remember when we first started, there was so little regulation, so much uncertainty in terms of what digital assets are. And then now, fast forward 5 years to today, is so different. We are starting to see a very robust framework about digital assets, not just for cryptocurrencies, but also for stablecoins. And going forward, there could be even more clarity. So I think we are already seeing a shift from digital assets being preserved of degen investors to now being an established, fully institutionalized kind of ecosystem. But we'll talk a bit about that later. For now, let's just have a brief recap about what Bitcoin and Ether has been doing in the markets. So just looking at this table over here, you could see a very astounding amount of returns that have come through in Ether. We have seen a near 50% increase month-on-month gain. Part of it is due to treasury buying for Ether, but also part of it, there's a story behind Ether, which is that it is the network that's being used for stablecoins. So it is inevitable that Ether demand could be supported somewhat as stablecoins start to be rolled out, not just in the US, but perhaps even in places that we don't expect, right, in Asia. If you look at the year-to-date returns, obviously Ether is the standout, but Bitcoin has also done pretty well. It has outpaced the S&P 500 by quite a fair bit. Year-to-date returns about 24%. Correlation with risky assets are still very high. It's still at about 0.5 to 0.6 in terms of return correlations with the equity market. So digital gold, not quite, still very much dependent on how capital markets are doing. And we see capital market exuberance is definitely supporting prices to some extent. It's not just in public markets, but also if you look at private market space, the valuations of cryptocurrency startups are actually rising. If you've been speaking in the venture capital circles. Next slide. I'll just briefly cover what has been the major drivers of Bitcoin market trends. So we know the progress towards institutional participation was really kickstart back in January 2024 when SEC proves the listing of Bitcoin ETFs. Then subsequently, we've seen a period of very stable Bitcoin prices before a leap up, right? Because of Trump's promise to make US the crypto capital of the world. Has he delivered on that? I think the jury is still out, but definitely progress has been made in terms of setting a regulatory framework, in terms of establishing the policy drive to try to ease regulations as well as to allow more innovation to come through in the US digital asset ecosystem. But of course, it's not all hunky-dory. So earlier this year, there was a hack on a digital asset exchange. That really hurt sentiment to some extent. We see Bitcoin prices correcting from a previous high, about 100,000, traded towards 80,000. But subsequently, we have seen it recovering quite a fair bit. And I think a large part of it is because of sentiment, right? Because markets were preparing to some extent for the introduction of the US Genius Act, which will set a regulatory framework for stablecoins. Why is that important for Bitcoin? I'll go on to that on the next slide. So here's the slide that shows the Bitcoin prices over the last 2 years versus the number of stablecoin searches on Google. And you could see actually stablecoin searches easily grew by 10 times after the Genius Act signed. But prior to that, there were already a lot of positioning, I would say. Crypto natives were discussing about the implications of the Genius Act. What does stablecoin mean for the entire crypto asset ecosystem, right? So there was, I think, to some extent, a little bit of positioning ahead of this. We see Bitcoin prices actually firming up quite a fair bit before the Genius Act was signed. And after it was signed, actually, the moves was not particularly high. So it showed, I think, to a large extent that markets, Bitcoin markets, crypto markets, they're all very forward-looking. They are essentially trying to map out how regulatory changes, how legislation are shaping the digital asset environment and positioning for that in the markets. So this is one area where I think we have seen a lot of progress, a lot of efficiency in crypto markets today that were not present 5 years ago. Next slide. So what else has the US lined up for us in 2025, right? So already we're in August, and there's been a ton of changes. That first off, we have the US announcing a strategic Bitcoin reserve back in March. So that really, I think, delivered on Trump's campaign promise. And also subsequently, we have the promotion of stablecoins through the Genius Act. But what's more exciting to us is that there's a lot more things coming through. It's not just stablecoins. The US Presidential Working Group for Digital Assets had released a report in end July containing over 100 legislative and regulatory recommendations. So these recommendations, they are quite wide-ranging. But the important point is that it sets the direction for regulators, and this include the SEC, the CFTC, to implement these recommendations, whether or not through the imposition of or tweaking of regulations, or also at the same time pressuring the legislature to move forward on certain legislation that will enable the digital asset ecosystem to continue to scale. So next slide, please. So what are some of the highlights from this report? So this report is a very thick document. There are 5 major areas of recommendations. You can classify them as market structure, stablecoins, banking, countering illicit finance, and taxation. I'll just pick on 3 areas that are particularly pertinent, I think, for cryptocurrencies. The first one is on market structure. So what does that mean, right? So right now, it's not very clearly defined, what are some of the crypto tokens, whether are they supposed to be governed under a security rules, or are they to be treated as commodities? We know that Bitcoin and Ethereum, Ether, they are all both considered as commodities, but there's also a wide range of altcoins, right? So what is the status of all these tokens? Very unclear. So the PWG report suggests that there should be differentiated regulations for these different kinds of tokens. Security kind of tokens will be regulated by the SEC. Commodity tokens such as Bitcoin, Ether will be regulated by CFTC, which presumably will be a lot less onerous for token issuers to comply. And finally, you have things like utility tokens for consumer and commercial applications. So this could include meme coins, NFT, collectibles. And what that means is that perhaps there will be safe harbor and exemptions granted to these utility tokens. So all this can only happen if there's also change in laws in the US. So the PWG has advocated support for Clarity Act. So this Clarity Act is an evolution from the FIT 21 Act that passed the House but didn't quite clear Senate last year. So this Clarity Act will ideally be able to give a very good regulatory framework across tokens, spanning not just from stablecoins, but also across security and asset tokenization kind of initiatives. So the second pillar is stablecoins and broadly also support for emerging innovation like tokenizations. So what's so good about stablecoins, right? What's the big deal? It is a huge, I would say, a change in the global monetary system, because what it means is that for the first time we have a digital currency, right, that is private, not controlled by governments, but also at the same time given a lot of regulatory protection, so that people will be comfortable to use it for their digital transactions. Stablecoins already exist before this regulation, but by and large they have been restrained or constrained to just to folks who trade crypto. They're not really used in real life transactions. But if you think about it, stablecoins on the blockchain, they offer a lot of advantages that could translate very easily to the real world. One, they would lower transaction costs. So if you know things on the stablecoin is basically on the internet, right? So there's no such thing as boundaries. So for cross-border transfers right now, the World Bank estimates that if you want to send $200 as remittance to an emerging market economy, you probably have to pay about 2.4% fee as transfer cost. But on the stablecoin network, bandwidth is essentially free, right? So you can use Ether, Bitcoin, so on and so forth for your cross-border transfers. Maybe you pay 0.1%. So that's a huge amount of efficiency that can be attained with stablecoins. Second part of it is this idea of atomic settlement across 24/7 trading, right? So that means that a modernization of current settlement, payment settlement infrastructure. So you have atomic settlement with very high settlement efficiency, very low chance of settlement failure. So that means that essentially banks will not have to hold as much capital, or institutions do not have to hold as much capital to guard against failure of settlements. And lastly, there's also better privacy involved, given the fact that there will be different stablecoin issuers, or you could hold wallets with different issuers and therefore be able to hide or mask your transaction to some extent. But by and large, the innovation is that once stablecoins become very well established, everyone has a wallet on the crypto blockchain. It will actually support the emergence of tokenization of real world assets. So that's, I think, the next big driver that could move crypto markets, where you see previously impossible to do transactions like buying real estate or buying bonds, stocks, in a very low cost fashion over the crypto blockchains, and being able to do that on a 24/7 basis. I think that's going to be very much a game changer for capital markets. Last point, banking and digital assets. What the PWG report recommends is that there should be regulatory guidance and best practices set for trading, custody, lending, and tokenization on the blockchain. And also at the same time, intriguingly, they say that if the digital finance companies want to apply for bank charters they should be allowed too. So there will be greater integration, I think, between the traditional financial companies and digital asset companies going forward in the future, and that probably will help promote innovation and more competition, I would say, in the banking and asset management sector. So that's all we have in a nutshell. A lot to digest, and there's a lot to look forward to in the US going into 2026. Next slide. So maybe some of you could ask, what is tokenization? And in fact, it's really just the usage of a blockchain to record ownership of an asset, right? So, what kind of assets can be represented by a token? Essentially everything. It can represent financial assets like stock, bonds. It can represent physical assets. So in China, there are tokens that represent EV charging infrastructure. So if you own those tokens, you can collect some income from whatever the EV charging infrastructure earns. Or you could even be a representation of virtual asset. You can represent Bitcoin or some kind of derivatives around Bitcoin with a token as well. So how does this process actually work? So it's relatively straightforward. The issuer will source for an asset to be put into custody, and then they could issue tokens that represent those assets. So these tokens, they can then distribute out to investors through an issuance process. And then subsequently, the secondary market could develop around these tokens. And also at the same time, the issuer might also have some redemption policies for the tokens at the cost, of course. And there's really a lot of potential scope for, I think, increasing efficiency around the way capital markets work. Right now, capital markets, you have to be deal in size to get efficiency. You can't really just do $100, $200 kind of investment for very large assets. So the idea of tokenization is that you can fractionalize very large assets, make them illiquid assets liquid to the market, bring them to public markets, and to some extent, increase the transparency of these assets, right? So a lot of these assets, they may not be valued regularly. Nobody knows what's the valuation. But once tokens are trading on the secondary market, it's very easy to get prices for them. But of course, there are some important points to note about tokens. One is that tokens, they are not fungible for different issuers. They might be fungible for the same issuer based on the same asset, but different issuers could have different redemption policies, right? So you could see some issuers setting restrictions on the amount of redemptions that can be done, or keeping or setting aside some time limits for them to do redemptions. So liquidity premium for tokens could be different depending on the policy or redemption policies. Also at the same time, secondary market liquidity is not guaranteed, right? So there will be market makers, but how many market makers could be participating in token markets is very much dependent, I think, on the issuers. So by and large, there are a few ways that tokens can be integrated on top of traditional banking system. So traditional banking system, you see an on-ramp of money going into the blockchain ecosystem via tokens, via secondary market trading, and then the off-ramp can also be done through similar channels. Next slide. Right, so this chart over here shows the amount of real asset tokens that are outstanding. So if you just take a look at it, we have about $25 billion worth of asset tokens right now based on real assets. A large proportion is in private credit. Second biggest is US Treasury debt. And this is really huge amount of growth that compared to where we were 5 years ago, where essentially there's almost no such real asset tokens. So going forward with more regulatory clarity, there's actually a lot of scope for tokenization to take off once issuers are very confident of the regulatory environment that will allow businesses to scale. And then, as I mentioned, there's a huge amount of advantage. There's a large number of advantages associated with tokenization. You can enhance liquidity. You can provide access to everyone globally. There's no such thing as boundaries on blockchain networks. Very high amount of transparency. Also, intriguingly, we could have new possibilities like smart contracts. So these smart contracts could be linked to certain preconditions. They could act a bit like the contracts they see in prediction markets, like certain event happening. For instance, you have natural disaster in certain places, and then you get certain amount of payout. So it could introduce new possibilities for insurance markets, for hedging of financial risk, for instance. And last but not least, settlement efficiency and low cost. These are also good reasons to put assets on the blockchain. So with that, I think that's the end of my section. I will pass on to Samuel to continue on stablecoins.
Thank you, Wei Liang, for the fascinating discussion on the tokenization. So I move on to stablecoins in my next section, and then I'll pass on to Nathan for the latest development of stablecoins in China and Hong Kong. So so first of all, just a brief discussion on the key comparison between CBDC and stablecoins. So CBDC is usually CBDC is the central bank digital currency. So of course it has to be issued by the central banks, and it is also somewhat a digital form of the currency itself. So that's why it is considered as M0. Which is just part of the money. But stablecoin is issued by private entities, and then it is instead of supported by sovereign guarantee like like CBDC, it is supported by fiat reserve or algorithm. But in most cases, like US and Hong Kong's legislation, they are not talking about the algorithmic stablecoin. They're talking about they are regulating the stablecoin with a fiat reserve. And then for credit risk, CBDC generally have lower credit risk compared to stablecoin because it's backed by the central bank. And then, so in a nutshell, CBDC is more like provide the regulatory certainties by the central bank and foster the monetary policy implication or transmissions. And then for stablecoin, it's more like for innovation or faster payments that fostered by the private sector. So moving on, just a brief discussion or overview on the stablecoin market capitalization and transactions. So the market cap of stablecoin has been rising all the way to around like 250 billion US dollar as of second quarter of 2025. And according to different financial institutions or IMF, BIS, kind of international organizations, the market cap of stablecoin could reach around like 1.4 to 3.7 trillion by 2030. So the midpoint is around like 2 trillion. And then for the transactions amount, so right now the transaction amount for stablecoin is already like 36.8 trillion on an annual basis, so which is even more than Visa or MasterCard combined. And the monthly transaction hits 800 billion in June. But of course, 80% of it is actually crypto trading, right? So that left a much smaller amount of the real world use case of stablecoins at the moment. But as discussed by Wei Liang, we are seeing more use case moving forward. And then, so I think the main takeaway of my section here will be the inflow into the short-term US Treasury and what is the impact on rates and FX. So for the U.S. Treasury, the inflow into U.S. Treasury, now the Genius Act requires the stablecoin issuer, all the stablecoins have to be backed by short-term Treasury bills on a one-to-one basis or by cash. So if we look at the 2024 figures, stablecoins is already top 10 U.S. Treasury bills holder in 2024. And the amount of their holding is even more than China. And then in terms of purchases, stablecoins actually is already the number 3 T-bills purchaser or buyer in last year. So it is just right after some big global market money market fund or just behind China. They are the number 3 already. So there are a lot of more inflow into the US Treasury, especially the short-term bills. So here we reference the Bank of International Settlement (BIS) research or the impact of 3 months US Treasury bills. So on a 5-day average basis, in 2024, the stablecoins triggered around a 3.5 billion inflow into 3-month Treasury bills, and then that compressed the yield by around 25 to 30 bips in 30 days during a bull market. But if we control for the market volatility, the ups and downs of Bitcoin or Ethereum, then the actual impact was around like 2.5 to 5 bips, which is still not a small amount. So according to their projection, the stablecoin could come, if the stablecoin market cap is growing to 2 trillion by 2028, the 5-day inflow could be around 11 billion. And then the impact would be around like 6 to 7 bips on 3-month Treasury bills yield in a 30 days time horizon. So, but then the impact itself could be rather limited over the medium term. It is because if we are looking at the over the long-term figures, the 3-month US Treasury yield is highly correlated with the DXY index. But at the same time, if we put the DXY against the foreign holding of US Treasury bills, it is the correlation is not so strong at around like 0.19 only. So that means for the DXY and US Treasury yield, they are more correlated with each other due to the the Fed policy or safe haven demand rather than the the inflow into the US Treasury bills, this kind of assets. So over the medium term, we think the impact would be more complicated or rather muted. So I mean, for the US for the impact on the US dollar rate, we have to segregate the impact of a foreign inflow case and also a domestic inflow case. So for a foreign inflow case, that means, let's say a foreigner, they are buying a US dollar stablecoin that is essentially exchanging their local currency, let's say Hong Kong dollar or CNY or SGD into a US dollar asset. So that means there is an inflow into US dollar assets. And then the stablecoins will buy, the stablecoin issuers will buy the US Treasury bills, and then it will lower the US Treasury bills yields just as what BIS has discussed. And then perhaps US dollar will strengthen due to the inflow. But then for the domestic inflow, it is a different case because that means that you are swapping the US dollar deposit into stablecoins, and then that means the banks hold less deposit and also less reserve, and then also less bills and less US Treasury bills or bonds. And then that means and then the stablecoins issuers, they will buy the bills again. So that will largely or even more than offset the outflow from the banks. But then on a net basis, there is an outflow from US Treasury bonds because for banks, when they receive the deposit from the customers, they buy both short-term bills and also bonds, longer term bonds. But for stablecoins, they only buy the short-term Treasury bills. So that means the demand for short-term bills is higher than the demand for the long-term bonds. So if that is the case, we are looking at a steepening curve for domestic inflow, and for FX markets, that would mean the more relatively steady, DXY in this case. But then over the short to medium term, there is another impact that we have to mention, is that the banks may have to raise the deposit rates. So in the initial phase that stablecoins are not interest bearing, that is relatively okay because the competition between stablecoins and traditional deposit is not so strong. But then when the stablecoins are allowed to be interest bearing, maybe in a couple of years' time, then there will be a stronger substitution effect between the deposits, US dollar deposits, and the US dollar stablecoins. And then banks may have to raise the deposit rate. So at the end of the day, they may have to raise the loan rates as well. So in the medium term, when the stablecoin is interest bearing, then the bank interest rate may increase over the medium term. And then there is another implication over the monetary policy, which is, let's say for Fed fund interest rate hike scenario, that would means that opportunity cost of holding a stable coin is higher. Let's say if stable coin is still non-interest bearing, but then your deposit rate is higher during a rate hike cycle, then that means there will be lower demand for stablecoin, and then stablecoin issuer may have to sell the U.S. Treasury if they hold less, and then the U.S. Treasury yield may rise even further, especially for the short end U.S. T-bills. So, and then whether the Fed have to, adjust the monetary policy, the pace of it, then that will be another question. So moving forward, there may be some, implication on the monetary policy setting moving forward. And then, as Wei Lan have mentioned, I think I will just quickly go through this, as Wei Lan has already mentioned, the use case of stable coins on tokenization. So right now, let's say for the banks, for the upstream, banks of course can be an issuer because bank has very sufficient reserve to back up the issuance. But I think in the initial phase, perhaps it will be more on the custodian services kind of services first, and then in the midstream, of course, DBS already we have the DDX, and then banks may also work on the exchange. But then for the most applicable cases, or for the banks or financial institution, is the downstream. So how they tokenize the deposit or loans, or they create escrow accounts for their customer. That will be the main application of stablecoins moving forward. So here we just have a bit of the example here, like for example, like tokenization of fund management, and then for example, investor may first lock their stable coins in the in the wallet, which is also escrow account from a traditional banking services perspective. And then when the fund manager confirm that they received the money, and then the fund manager will receive release the fund to the investors. So this kind of tokenization on fund management and escrow account would help foster the fund management moving forward. And then for, let's say for real estate, I think we showed this before as well. So let's say for real estate, the ownership can be sliced into different maybe 5-10 owners, and then also at the same time the mortgages for one particular property can also be sliced up into different pieces and then owned by different banks as well. So that will also means fostering the the loans to customer through on the mortgages or on other real estate assets. So hopefully moving forward there will be more use case on this kind of stable coin moving forward, and that will even further the transaction or the market cap of stablecoin moving forward. So and then as Wei Lan also mentioned, a lot of the transaction of stablecoins actually based of Ethereum platform, as Ethereum platform is the main platform for the smart contracts and so on and so forth. So with this stablecoin, DeFi, NFT transactions, then we can see there will be more, real demand usage of Ethereum moving forward as well. And that's the reason why, if we look at the chart here, the Ethereum performance has been catching up so fast since the Genius Act has been passed. So you remember in our past reports, actually we have a chart stating that the BTC to Ethereum ratio has been growing sharply. That means Ethereum cannot catch up with the BTC prices over the medium term. Or over the past 2-3 years, but this is not the case this year, especially after June. In the first few months of this year, Ethereum lost around like 20 to or maybe even 50% of its value. But after June, it has been catching up so fast, especially after the Genius Act has been passed. So moving forward, you may see the Ethereum may continue to catch up with the price performance of BTC if there is growing transaction or usage of stablecoins on Ethereum platform. So, and then I will move on, and then I will pass it to Nathan for China and Hong Kong stablecoins development. Thank you.
All right. Thank you, Sam. Regarding Hong Kong, the city has recently rolled out its stablecoins bill.
Nathan?
Yeah.
Nathan, just give me 1 minute, please, okay?
Yeah, sure,
Thanks.
please.
Just stand by. So just before Sam completes his thing and Nathan goes in, just want to address a couple of questions related to stablecoins, and I'm sure Nathan will find some resonance on what I'm about to say, but let me just talk about it in general, not necessarily specific to the US or China or Japan, Hong Kong, is that there are some really tantalizing and troubling aspects of the brave new world of stablecoins. Because at the end of the day, there are certain tests of money in the conventional sense of the matter. One is ubiquity, that a central bank issues currency, and every single dollar that they're issued, it is protected against counterfeit. It's a guarantee of the government sovereign that the value of this thing is a legal tender. Can a stablecoin issued by entity A versus entity B be seen or will be seen by the market exactly the same, or are we going to see some stablecoins all ostensibly backed by US treasuries and it's a 1-to-1 USDC, but markets will not treat them exactly the same? Some entities would be seen as AAA and some not. That's a very big question, a question we never ask in the question of in the context of money. Similarly, the issue related to elasticity. If you are a central bank, you can change the supply of money through interest rate channel, through open market operations. You can adjust liquidity. So there's an elastic element with respect to the supply of money, which can be changed by the authorities depending on the demand situation, depending on the state of the economy. Not clear at all if stablecoins can play in that area whatsoever. And thirdly is the issue related to regulation. Again, a fiat currency issuer will stand by the sanctity of the monetary regime, will stand by the fact that it will have security features so that it cannot be counterfeited, or if there are certain local regulations with respect to capital controls, with respect to know your customer, that all of those will be in the context of the monetary authority and financial supervisor. Will stablecoins have all of those things? Not clear at all. Now, that's the risk area. And as you can see on the slide that Sam has put in, or I don't know if it's Nathan's slide or Sam's slide, but about HKMA sort of thoughts on stablecoins and the US Genius Act, it'll be a good compare contrast. But let's keep those three things in mind: ubiquity, elasticity, and governance as we think more about stablecoins. And then there are bigger questions that if indeed I can borrow from you at zero or very little interest rate, and then I get the entire cash deployed with the government securities and get the government give me 2%, 3%, whatever, depending on which jurisdiction I am. I basically have a free float. And then why on earth would people keep money in banks? They can just do it here. As Will Young said, that these things allow you to move things around faster, cheaper. Then what happens to the state of fiat money? What happens to the state of conventional banking? So there's some very, very profound questions that I don't think the US authorities have fully thought through before going ahead and turbocharging the whole stablecoin dynamic. And now, as you can see, both the Chinese and the Hong Kongers are scampering to be on top of it. All right, so there's a whole geopolitical angle as well. But before that, let's go to Nathan and hear from him.
All right. Thank you, Tamo. So let's go back to Hong Kong. And the city has recently rolled out its stablecoins bill, just like what Tama has mentioned. It's all about creating a solid framework for stablecoin issuers backed by real cash, like the Hong Kong dollar or US dollar, and potentially the Chinese yuan as well. So the HKMA and the FSTB, Financial Services, and the Treasury Bureau are leading the program. So the aim is to keep the development stable and transparent, to protect investors, and to make Hong Kong a big player in digital finance. And as Sam already mentioned, and Wei Liang has already also mentioned, stablecoins are digital tokens tied to stable assets. They're super important for crypto trading and decentralized finance, and potentially cross-border payments as well. But with their rapid growth, there have been some serious issues like not having enough reserves, fraud and risk that blew up in 2022 with the Terra USD collapse, right? So that is one of the reasons why the Hong Kong government wants to regulate the market. And the Hong Kong's bill actually borrows some ideas from the global counterparts, like the Genius Act from the US and the EU's MiCA, the Markets in Crypto Assets Regulation. So it sets standards for reserves, operations, and disclosure, building on the Hong Kong's earlier crypto exchange rules from 2023. Okay, so put it simply, right now, it only allows fiat referenced stablecoins, such as those tied to the Hong Kong dollar and US dollar. It doesn't cover algorithmic and or commodity-backed stablecoins for now. Okay, so if you want to issue stablecoins in Hong Kong, you have to get a license and follow strict rules like full asset backing, redemption guarantees, and being transparent. The HKMA is the main regulator, handling licenses and making sure everyone plays by the rules. So to get a license, you need to show to the HKMA that you've got solid governance and risk management in place. And as far as financial requirements are concerned, issuers need to have at least 25 million Hong Kong dollar in paid up capital and 3 million in liquid assets. And of course, you need to have enough extra cash, liquid capital, to cover a year's expenses, 12 months expenses. So this ensures only financially strong players can enter the market, okay? And a key part of the bill is the full reserve requirement. Issuers have to hold high quality assets like cash or short-term government bonds that equal 100% of the stablecoins they issue. They need to guarantee redemptions within 24 hours, keeping users confident. And not to mention, they also have to follow strict anti-money laundering and counter-terrorism financing rules, like verifying customers for big transactions and keeping an eye on wallet activity. So the goal is to keep the market clean and secure. But put it simply, because of all these regulatory requirements, we think existing banks or existing payment providers might get a quicker approval process because they're already under regulatory scrutiny, right? And oh, by the way, the bill has strict identity verification rules. Issuers have to keep detailed records of every stablecoin holders. So it's good and bad. On one hand, it boosts transparency, but on the other hand, it raises privacy concerns for some market participants. All right, and all these compliance requirements come with costs, right? Obviously, so that could put off some smaller issues. Some might decide it is just not worth it. So it is clear that the regulators in Hong Kong are being cautious, but for good reasons, because at this moment, mainland China still bans stablecoins. Yesterday, there's an announcement that China's government is also evaluating the RMB-backed stablecoins. The State Council is set to review a roadmap on stablecoin usage later this month. So against this backdrop, Hong Kong is effectively a test bed. So that is why Hong Kong regulators want to prevent any spillover risk. Okay, so that explains why Hong Kong regulators are taking an extra careful approach. They got to play safe. All right. So and we are actually already seeing why caution is needed. There are some scammers, not just in Hong Kong, but also in the mainland. Some cities like Shenzhen and Beijing. We are seeing scammers are hyping stablecoin investments with unrealistic returns to lower people. All right, so that's why stablecoin advertising on the mainland for the time being is now banned. And in Hong Kong, regulators also moved quickly to rein in speculation because, like 2 weeks ago, a number of stocks surged crazily after companies merely said they might explore issuing a stablecoin. So that's why you see HKMA warn investors to be cautious about chasing such hype. All right. stepping up market monitoring. They are also watching closely for any irregularities. And the HKMA has also repeatedly stressed that when licensing begins in early 2026, only a small number of applicants, top-tier applicants, will be approved. Okay, so they want stability, not hyper-growth. And moving on to next slide, one of the most common questions we get is how stablecoin going to affect the daily life for ordinary household or people in Hong Kong, right? Frankly speaking, not right away, and maybe not much at all in the short term, because if you live in Hong Kong or if you ever been there, all people use Octopus card and restaurant and transportation, and alternatively you can use credit card or Alipay, WeChat Pay, right? So there is no urgency to switch, for the time being. So right now, Hong Kong dollar stablecoins are mostly aimed at support things like cross-border payments, financial innovations, and fintech use cases. So unless you are into crypto, work in digital finance, or running a business with international operations, you probably won't feel the impact in your everyday life just yet. Yeah, so it's mainly for corporate use, for making cross-border payments, because it is faster, it is cheaper, right? And it is not just for Hong Kong companies. A lot of Chinese companies would benefit as well, because even though stable coins for the time being are not yet available in mainland China, but there's a lot of Chinese companies do their fundraising, banking, and offshore payments through Hong Kong, right? And now stablecoins got the go ahead in Hong Kong, so it could change the game for this group of companies when it comes to moving money, managing currency, and tapping into global liquidity without crossing any China current rules, right? For instance, their Hong Kong subsidiaries could use stablecoins for cross-border B2B payments with suppliers outside of mainland, and they could also park and move US dollar liquidity under Hong Kong regulation, because theoretically it is faster, right? 24/7 settlement with potentially lower fees than traditional banking, all right? And just like what I have mentioned, Hong Kong's approach is strict on purpose. The one-to-one reserves thing and audits, licensing, if it runs smoothly, Beijing going forward might green light small, controlled cross-border pilots, very likely via the Greater Bay Area through specific banks, like other offshore pilots that we have seen. All right, so we should not underestimate the development, because if everything goes as planned, Hong Kong stablecoins could supplement with traditional US dollar payments for trade with Asia, the Middle East, and emerging markets. For instance, Chinese exporters with Hong Kong entities might prefer these payments for because of it is faster and it is cheaper, right? Even if the onshore company itself still cannot touch stablecoins, right? And according to the latest research from the BIS, just like what you can see from the chat here, cross-border stablecoins flow have been picking up since 2023 again, right? So especially in emerging market countries that are dealing with high inflation and currency swings. And because China's exports to emerging markets are growing fast, so I would say it wouldn't be surprising if some of those transactions start getting settled in stablecoins in the future, okay? And this could play a role in advancing renminbi internationalization as well, because beyond Hong Kong dollar and US dollar stablecoins, there is a possibility that we will be seeing RMB referenced stablecoins in the future, right? And I have put up some charts on next slide, give you a reference in terms of renminbi internationalization. So right now, over half of China's cross-border settlements are already done in the Chinese yuan, around 52%. So it is possible that some participants might convert into CNY stablecoins to handle their transactions in the future when it is available, right? And as far as the impact on interest rates are concerned, next slide, please. We could pretty much just like what Sam has discussed, we could see downward pressure at the short end when stablecoin gains traction. Because as stablecoin demand grows, let's take the Hong Kong dollar stablecoin for instance. Issuers of Hong Kong dollar stablecoins will need to buy more high quality collateral like short-term Hong Kong government bills and notes, which can in turn bring down the front end yield, right? And actually, this demand could help finance the fiscal deficit in Hong Kong as well, because Hong Kong has run budget deficit for 3 consecutive years. That is the longest back-to-back deficit since the Asian financial crisis. And the Hong Kong government debt remains low at roughly about like just 3 to 4% of GDP, way below the international average, meaning there's room for further issuance, definitely. Okay, so that is one of the implications in terms of rates, and similarly for the CNH rates as well. Okay, so that wraps up my part. Over back to you, Pamo and Wei Liang.
Sorry, thank you very much, Nathan. We've had a few requests for the slides to be shared. We could, I suppose, put it on the WebEx chat message section, or anybody who would like it, you can just email us and we'll be happy to send it to you. No problem whatsoever. And it is for public distribution. It is compliance clear. No issues there. Do we have any questions? Yeah, I think Andrew Chua has a question. How would stablecoins adoption affect FX stability, given that private entities control stablecoins issuance rather than central banks? In case of Hong Kong, what are the impacts? What are the impacts that stablecoins have on the yuan's fixing rate? Sam and Nathan, you want to take this question? You can see it, right?
Since I'm sharing the screen, so I couldn't see the question, but yeah, just on the FX stability, I think since there is inflow into US dollar stable coins, then that means US dollar should be strengthened in the short term. But as we have discussed, over the medium term, that the US dollar is, the movement of US dollar hinges on the Fed policy and say having demand instead of the capital inflow. So I wouldn't see a big disruption of the stablecoin issuance on the overall FX markets over the medium term. But of course, on the Hong Kong dollar rates, I think it will help, compress the Hong Kong dollar rates over the medium term, because I mean the Hong Kong dollar government bonds market is not like the US market. It's very small, and there is always questions on why the Hong Kong market is so small, and then the supply of Hong Kong government bond is so limited. So if the demand is quite strong when we have the stable coin issuance, then that means the Hong Kong dollar rate has to be compressed, and that will also help compress the very front end high balls as well. But of course, if we are looking at the actual execution of the stablecoin, or actual usage of stablecoin, Hong Kong dollar stablecoin per se, I mean, the internet, let's, like Nathan has mentioned, the Hong Kong dollar stablecoin will be used for cross-border transaction, but also at the same time in the trade finance or cross-border transaction. Hong Kong dollar is around the 6th, 7th the biggest currency in the world, but for trade finance, but then it is still very, very small compared to the US dollar. So the actual, the movement of Hong Kong dollar stablecoin will be slow, and the impact on the Hong Kong dollar rate will be slow as well. So just want to see Nathan, if you have anything to supplement on this.
No, that's pretty comprehensive.
Okay. Thanks, Sam and Nathan. There is a question on Singapore and MS's stance and what we, and by that I'm assuming this question is coming from somebody in DBS, what we are doing in response to HKMA. I don't know the answer to the second part of the question, so I can't really answer it. On Singapore and MS, I think it's very clear. MAS has sort of gone with the BIS guidelines and have been fairly cautious about the digital ecosystem. There are numerous sandboxes, some of which even DBS participates in, particularly on the trade finance blockchain utility called Partior. But on stablecoins, no major announcement or anything for the time being. But given the ripples around the world, I mean, what's this space? Sooner or later, we'll hear something.
There is actually a Sing dollar stablecoin, but it's not widely used. It's called XSGD.
Isn't there a 1,250% capital surcharge on?
No, so this is issued by a non-financial company.
Okay.
So that's why
no capital requirement.
Yeah. But it's not widely used, so there's not really a lot of demand for Sing dollar stablecoin.
Okay, news to me. So it's backed up by SGS Securities, or just cash?
Yes, it's backed up by SGS Securities, and you get a guaranteed redemption from the issuer.
And zero coupon, or there's a coupon?
Stablecoins, there are usually no interest.
Oh, that's changing. Because, at the end of the day, it is basically a tokenized money market fund. And if you're investing in short-term securities with the proceeds, you can technically pay coupon. Now, of course, under the Genius Act in the US regulated stablecoins will not pay coupon. But that doesn't preclude stablecoins from paying coupon.
I think regulators are settling on the mode where no interest is allowed, so that it doesn't threaten the reserve banking system. So
right.
there's
that is a very key issue in there. Okay, I think we're going to wrap up the call. Thanks for everybody for your participation and your questions. And we've seen the request from David and Qishan on the request for the slides, and we're happy to comply with that. Take care, everybody, and we'll keep following this space. We're riveted by it, so we'll keep on following and writing about it, and I'm sure DBS will remain very, very involved too. Have a great day, everybody. Thank you, Sam. Thank you, Nathan, and thanks all the participants.
Thanks, everyone.
Thank you.
Bye bye.